In September, the Canadian government enacted a series of legislative shifts that fundamentally altered the landscape for the country's largest alternative asset managers. This is the story of what happened when the modernization of the Investment Canada Act met the strategic expansion of Brookfield Asset Management. For decades, Brookfield operated with a predictable domestic playbook, acquiring essential infrastructure and scaling it through global capital flows. However, the introduction of Bill C-34, also known as the National Security Review of Investments Modernization Act, has introduced a friction point that challenges the very speed and certainty Brookfield requires. These changes are not merely bureaucratic updates, they represent a protectionist pivot in a nation traditionally defined by its openness to the global market. As the federal government grants itself expanded powers to freeze deals and impose interim conditions, the era of frictionless asset consolidation is facing a quiet but firm reassessment. This transition suggests that the intersection of national security and private capital is becoming the most complex terrain in the Canadian economy. The mechanism driving this disruption is a profound expansion of ministerial authority over foreign and domestic investment flows. Under the new rules that came into force on September 3rd, the Minister of Innovation, Science and Industry no longer requires a full cabinet order to launch extended national security reviews. This procedural change allows the state to intervene earlier and more decisively in transactions involving critical infrastructure, which is the core of the Brookfield portfolio. For a firm like Brookfield, which oversees roughly $900 billion in assets, the primary value proposition to its investors is the ability to execute high-stakes deals with surgical precision. When the regulatory environment shifts from a predictable framework to one where the government can impose interim conditions, such as restricting access to intellectual property or sensitive assets during a review, the economic cost of capital begins to climb. The system now prioritizes economic security as a primary pillar of national defense, a move that effectively slows the velocity of the infrastructure playbook. Statistical evidence from the 2023-2024 fiscal year highlights the growing intensity of this screening environment. The Canadian government reported 201 investment filings during this period, the second highest total on record. While the number of full national security reviews decreased slightly from the previous year's all-time high, the complexity of the cases has reached a new threshold. Of the investments subjected to extended scrutiny, nearly half resulted in either divestment orders or the withdrawal of the deal by the parties involved. This high rate of attrition signals to major allocators that the net benefit test is no longer a simple calculation of jobs and capital. It is now a rigorous assessment of strategic dependencies. For Brookfield, which often acts as a bridge between international pension funds and Canadian assets, these rules create a secondary layer of risk. The firm must now account for the possibility that its global partners, particularly those from non-treaty jurisdictions, could trigger a review that stalls a multi-billion-dollar project indefinitely. The disruption extends beyond the Investment Canada Act into the realm of domestic tax and corporate structure. In late 2024, Brookfield Infrastructure Corporation was forced to undergo a significant reorganization to address proposed amendments to the Income Tax Act concerning mutual fund corporations. These tax changes, introduced in the 2024 federal budget, threaten to increase the operational costs for Brookfield's unique corporate structure, which allows investors to hold economically equivalent shares of its global partnership. To preserve the benefits for its shareholders, the firm had to implement a court-approved plan of arrangement and seek a reorganization that would maintain its inclusion in global indices. This internal restructuring highlights a broader theme. The Canadian regulatory environment is becoming more restrictive for the very vehicles designed to facilitate massive infrastructure investment. The confluence of national security scrutiny and tightening tax rules is forcing a total recalibration of how these essential assets are valued and held. On a global scale, Canada's shift mirrors a broader trend among the Five Eyes Intelligence Alliance to ring-fence sensitive sectors. From the United States' expanded powers under CFIUS to Australia's new restrictions on critical minerals, the Brookfield Playbook is encountering similar barriers in multiple jurisdictions. In 2024, the Canadian government explicitly stated that foreign investments resulting in a change of control for important mining companies would only be approved under the most exceptional of circumstances. While Brookfield's primary focus remains on utilities and transport, the government's definition of sensitive sectors has expanded to include advanced digital infrastructure, data centers, and clean energy systems. This global reassessment is turning what was once a borderless market for infrastructure into a patchwork of complex regional compliance zones. The result is a cooling effect on private equity firms that previously viewed infrastructure as a liquid, universally tradable asset class. The real-world impact of these disrupted rules is already visible in the shifting geography of Brookfield's capital deployment. As Canadian regulations tighten, the firm has increasingly looked toward international markets, such as the Middle East and Europe, to place its largest tranches of capital. In 2024, Brookfield completed the acquisition of Network International for $2 billion, choosing to expand its payments platform in the United Arab Emirates rather than doubling down on similar domestic fintech or infrastructure plays. For the Canadian public, this shift implies a potential funding gap for the massive upgrades required for local power grids, transit networks, and housing developments. Data indicates that when regulatory uncertainty increases, the risk premium on long-term projects rises, making it more difficult to finalize the complex funding structures that sustain national infrastructure. This is not a sudden collapse of investment, as Canada still attracted record foreign direct investment in 2024, but it is a fundamental change in who is allowed to own the backbone of the economy. The tension between the state's security goals and the market's need for efficiency has reached a tipping point. The 2024 amendments to the Investment Canada Act include new authorities for the minister to disclose information about specific investments to foreign governments, facilitating a level of international cooperation that was previously impossible. This means that a deal scrutinized in Ottawa is now effectively scrutinized in Washington and London simultaneously. For a global titan like Brookfield, this creates a cascading risk where a single regulatory hurdle in one jurisdiction can trigger a chain reaction across its entire portfolio. The firm's heritage as a Canadian owner-operator is being tested by a government that is increasingly willing to prioritize long-term sovereignty over immediate liquidity. This shift signals to the market that the quiet era of infrastructure consolidation is over, replaced by a more disciplined and cautious approach to national assets. As the Canadian government moves forward with its 2025 agenda, including the establishment of a foreign influence transparency registry, the scrutiny on large-scale capital allocators will only intensify. The minister has equated economic security with national security, a stance that broadens the government's interventionist reach to almost any sector deemed critical. This policy evolution is designed to prevent opportunistic takeovers and protect intellectual property funded by Canadian taxpayers, but it also creates a higher barrier for firms like Brookfield that thrive on the seamless movement of capital. The resulting landscape is one where the state is no longer a passive observer of market forces, but an active gatekeeper. This transition is redefining the relationship between the Canadian government and its largest corporate entities, moving toward a future where every major investment must be justified through the lens of national resilience. The under-discussed shift here is the move away from a market-first infrastructure model toward a security-first framework. For decades, the assumption was that the best way to build a modern country was to invite the most efficient global capital to the table. The 2024 disruption of the Brookfield Playbook proves that this assumption has been discarded. We are now entering a decade where the stability of the grid, the security of data, and the control of supply chains are valued more highly than the speed of a transaction. For investors, this means that the golden era of easy infrastructure plays is concluding. The next phase of growth will require a far more nuanced understanding of geopolitical risk and a deeper alignment with the strategic goals of the state. Brookfield's ability to adapt to this new reality will determine whether it remains the dominant force in Canadian infrastructure, or if it will be forced to move its primary theater of operations elsewhere. Ultimately, the disruption of Brookfield's Playbook is a microcosm of a larger global reordering. As nations around the world reassess their vulnerabilities, the companies that manage the physical and digital world are being pulled into the center of the debate. Canada's decision to modernize its investment rules is a clear signal that the country is willing to trade a degree of economic velocity for a higher level of national control. This is a story of a quiet but profound transformation in how power and money interact at the highest levels of the economy. The consequences of this shift will be felt for generations, as the infrastructure built today will be the foundation of a more protected, but perhaps less liquid, Canadian future. The barrier has been set, and the rules of the game have changed forever.